Ambuja Cements operates at an immense physical scale. Backed by the cash-rich Adani portfolio, it is the ninth-largest building materials producer globally. For fiscal year 2026, the company's production facilities ran hot. Management reported a record-high annual sales volume of 73.7 million tons, alongside a 31% jump in normalized EBITDA. But the market reaction tells a contradictory story. This daily chart reveals a rigid descending yellow channel, trapping Ambuja's stock in a bearish trend. Despite record sales, price action is heavily compressed at the bottom edge, grinding between 435 rupees and 442 rupees. This technical posture indicates top-line volume growth is actively masking severe operational friction beneath the surface. To institutional capital, generating record gross revenue means very little if the actual cost to produce and move that volume is rapidly deteriorating. To understand why the stock is behaving defensively, we must bypass headline revenue and look at the internal diagnostics provided by Ambuja's executive leadership. The critical metric driving the sell-off is PMT, or per metric ton cost. It measures the raw operational efficiency of the business. By parsing the Q4 FY26 earnings call transcript, we can isolate exactly where Ambuja's unit economics failed to scale with their massive production volume. The street needs to know, are these compressed margins a temporary side effect of recent acquisitions, or is there a long-term structural flaw in the cement sector's current operating model? Diagnosing the technical breakdown requires tearing down the exact cost of aggregating these industrial assets. Prior to the Q4 results, management aggressively sold the street on a vision of strict cost discipline and expanding operating margins. This waterfall chart tracks their unit economics. Management committed to an exit rate target for March 2026 of a highly efficient 4,000 rupees per metric ton. Instead, the Q4 reality broke aggressively higher. The actual cost to produce a ton of cement spiked dramatically to 4,500 rupees. That gap represents a massive 10% overrun on their annualized cost estimates. Ordinarily, industrial producers protect their margins by simply passing those escalating costs directly to the end consumer. Ambuja, however, is currently operating with a severe pricing power deficit. Broad inflationary pressures and unexpectedly weak monsoons have softened national construction demand. This macro environment has hard-capped industry realization prices at roughly 254 rupees per bag. With consumer pricing frozen, Ambuja cannot shift the burden forward. They are forced to absorb the entirety of that PMT overrun directly onto their own balance sheet. Pushing record volumes of cement through the system at a significantly higher marginal cost, completely devoid of pricing power, is the exact mechanical driver behind the bearish channel. To find where that 500 rupees per ton overrun originated, we began with the friction points outside of management's immediate operational control. Domestic logistics took an unexpected hit. State-level regulatory changes, particularly new additional goods taxes implemented in Himachal Pradesh, inflated both primary and secondary freight lead costs. Furthermore, the balance sheet absorbed an abrupt spike in raw packaging costs, heavily concentrated in the month of March. The company explicitly tied this escalation to the expanding geopolitical conflict in West Asia, which quantified to an unexpected penalty of roughly 25 rupees per bag. These external supply chain shocks and sudden tax levies act as a forced penalty on the business, bleeding their margins before any internal factory inefficiencies are even measured. Beyond the macro shocks, Ambuja is suffering from significant self-inflicted friction driven by their recent large-scale market consolidation. The company has been aggressively pursuing a one cement platform, but the rapid integration of Sanghi Industries and Penna Cement has triggered a severe case of M&A indigestion. This dashboard displays the actual efficiency of those newly acquired assets. In Q4, the Sanghi plant operated at a sluggish 57% utilization rate. The metrics for Penna Cement act as an even heavier anchor, stalling out at a dismal 46% capacity utilization. Management admitted on the call that bringing these plants up to standard is taking significantly longer than projected. The assets require severe delayed maintenance capex and are suffering from unplanned machinery breakdowns. Bolting massive physical capacity onto your balance sheet actively destroys your consolidated efficiency if those new assets are burning cash below their break-even utilization limits. Facing this dual threat of external supply chain shocks and internal integration friction, management is actively changing their playbook. They are hitting the brakes on aggressive, inorganic capacity hunting. The immediate priority has shifted entirely toward a disciplined stabilization of their existing assets. This timeline illustrates their revised strategic goals. The hyper-growth target of 140 million tons is pushed back to fiscal year 2030. In its place, management established a near-term capacity benchmark of 119 million tons by the end of FY27. To enforce this, they've implemented a strict financial guardrail, officially capping the total capital expenditure for FY27 between 6,000 and 6,500 crore rupees. Rather than financing new builds, that capital is earmarked strictly to lift the operational utilization of the Sanghi and Penna assets by at least 5 to 10%. Pausing your entire building to resolve internal friction is a strictly defensive maneuver designed to protect their long-term return on invested capital. To claw back the 150 to 200 PMT savings required to reach their initial baseline target, the company will rely on 3 specific operational levers. First, they are accelerating the transition to renewable sources. Green power has already expanded to cover 32% of their total energy consumption in Q4. Second, they plan to adjust their clear factor and raw material mix by pushing for a highly streamlined integration of fly ash. Third, the company is aggressively pivoting its sales strategy heavily towards a trade mix, targeting direct distribution to capture higher premium pricing. The goal is to maintain a 74% overall trade mix volume, anchored by ensuring 36% of those sales consist entirely of premium cement products. Assuming the geopolitical energy market stabilizes, executing on these 3 levers provides management with a clear mathematical roadmap back to margin health. Returning to the technical chart reveals the institutional market's verdict. The downward geometry of this channel directly maps to the capex delay and M&A friction. The chart visually represents capital waiting on the sidelines. The market is accurately pricing in a difficult integration phase, a period where absolute physical capacity is extremely high, but the actual profitability of those assets is severely diluted. A technical breakout from this structure won't be triggered by raw volume growth. It requires verified, auditable unit margin expansion showing up in the quarterly filings. Ambuja is currently a strict execution play. This descending channel breaks only when management proves that their massive market aggregation actually generates bottom-line efficiency.